All right, I want to thank everybody for joining me for today's webinar. It's an Ask Me Anything session. The primary topic that I'm going to talk about today is this crazy low interest rate environment. What can we do about it? It's particularly difficult on you if you're a retiree because the ability to get interest income from our portfolio is way down from what it has been historically. So why do low interest rates matter? There's a few things that come to mind for me. First is when we retire, we're not getting a regular paycheck anymore, but you still need income. So your portfolio and your other assets and things that you've accumulated while you work, those are supposed to provide a retirement paycheck. And that retirement paycheck can have things like a pension plan, if you have that, your Social Security, which we should all have, and then your portfolio, your investments, and what do they provide you. And low interest rates make it much harder to get that income from your portfolio. When we think about our portfolio, we want to think about total return because there's two ways that our portfolio can provide income to us. One is the interest and dividends that it pays, but the other component is the gains or losses that the portfolio generates over time. That's a total return. We also have to think that it's not just about beating the market, especially when we're retired. It becomes probably even more relevant. It's about having a portfolio that meets your needs and allows you to live your desired lifestyle. Diversification can keep your portfolio from plunging along with the market as not all assets move together. Yes, it can limit your gains, but it also limits your risks. Hold on one second, somebody else wants to join. Thanks. Holding only one type of asset will also likely cause more fluctuation in the value of your portfolio. That fluctuation is volatility. We'll take a closer look at volatility a few more slides into the presentation. So I mentioned your retirement paycheck, and so those are your income sources in retirement. For just about everybody, like I said, it's Social Security is part of that. Pensions are much less available and offered much less frequently than they used to be, but that's another component. Your portfolio, if you especially have been a good saver, is a really important part of that. And I mention this term with a little bit of hesitancy because you have to be really careful, but annuities can be part of a portfolio, especially if you're very conservative and you have an emotional need in particular for your portfolio to provide a certain level of income. You just have to be really careful because annuities are products. They're sold by insurance salesmen. They get paid by commission, so they're incentivized to sell you those products. And there's a big difference between working with somebody that's selling you products and working on a commission base and somebody that's works for you on a fee-only base, as I do, and is providing advice that's in your best interest. So if you don't have enough income, what can you do? Well, if you need cash, you can sell securities to raise cash. You can also cut expenses. Cut expenses could mean you move, and I'm not talking about like relocating for retirement, but you might have to go to a place where your rent is less expensive or your home is less expensive because you can't afford the upkeep and other things that come with it. If travel was part of your plans and your goals, especially in retirement, you may have to travel less. Depending upon where they live, you may have to see your family less. And the bottom line there is it can lower your quality of life. So when you think about your portfolio, do you only own stocks? You have to consider your asset allocation. When we're young and we have a long life ahead of us, owning only stocks can make sense because you have the ability to make up for losses because you have a lot of years ahead of you. But as we age, our allocation to stocks should get to be less. Also, what factors into it is what is your risk tolerance? When I talk about risk, I mean, there's really two different ways to think about risk. One is price fluctuation or volatility, and that's the daily up and down movements in an asset's value. The other is the one that I think matters more, and that's the risk of loss. Right? Daily price movements, they include a lot of noise. The long term should be the true focus, and you want to stay away from things that can generate loss. And when I think about risk tolerance, I have listed here some of the things that come into play when you're thinking what your risk tolerance is. What's your time horizon? When do you need the money from your investments? How long will you take to spend it? How long, when you invest your money, how long do you typically keep it invested? How do you react when a market declines? I mean, there's two emotions that are really important in terms of governing how you act when it comes to your portfolio. And those are fear and greed. And so we want to try to do things to help keep us from having too much fear and selling at the bottom. And we also want to keep us from getting too excited and getting too greedy and buying at the top. Also in your risk tolerances, how much fluctuation in your asset values can you tolerate? How impulsive are you as an investor? And how stable is your income? You know, more income stability does make a difference. So let's start to take a look at volatility. So first here, you can see this chart, and it's a 1-year price chart. And what I did is I looked at some of the more conservative ways that you can get income in your portfolio beyond cash. And so we have a core bond portfolio, which is the light blue line. We have the short-term treasuries, which is the green line. We have intermediate term treasuries, so that's like treasuries that mature in 3 to 7 years. That's the yellow line, or the gold line, I guess, on the chart. And then the red is long-term treasuries. And you can see that long-term treasuries over the last year, they had the most volatility. The price moved the most up and down. The short-term treasuries, they hardly changed at all. And even the intermediate treasuries, they didn't change that much either. And so those are things that help give your portfolio a little bit of stability. And so if you have a balance of that, of those things that don't move as much with the things that move more, when we have a market dislocation, like especially like we had earlier this year, that's going to keep part of your portfolio from going down as much as the market and give you a little bit more cushion and hopefully keep your mind, make your mind a little bit more at ease. If you start to chase yield, the biggest concern is that you're taking on more risk. Here's some higher income options. We have things like high yield bonds, emerging market bonds, preferred and other income securities. You know, preferred stocks, they kind of sit in between bonds and stocks on the risk profile and the liquidity profile, just because if a company goes bankrupt, the bondholders come before the preferred shareholders, but those shareholders come before the common shareholders. Usually if a company goes bankrupt, if you own common stock, you would get nothing at the end of the day. We also have real estate investment trusts. Those are companies that manage real estate in some way, shape, or form, and they're required by law to distribute a good portion, it's 90% of their income, to shareholders. And then we also have the light blue line here, which is an ETF representing the S&P 500. But if you think about this chart versus the one that we just saw, you see that these securities, which, you know, those numbers after them, the 4.57% and the 5.39%, those are the yield that they provide. So you can see that the securities that provide more yield, they also provide more volatility and more price movement. So if you just start chasing yield in your portfolio, the biggest risk that you run is that now you're going to increase your portfolio. And especially if you are full of fear, you know, I talked to somebody earlier this year that told me in March, they had a portfolio that was largely invested in high yield bonds, and they sold them and had about $1 million of losses because they sold out at the bottom. And that's the type of thing we want to avoid. The other thing we're going to look at is a concept called correlation. Volatility and diversification are connected to correlation. Correlation essentially measures how the price of two assets changes relative to each other. Stocks and bonds have historically been inversely correlated. They move in opposite directions, at least to some extent. Treasuries, particularly if you're looking at long-term treasuries, they move in the opposite direction of stocks. It's difficult to find an example in history when the stock market has had a significant drop and returns for bonds over the subsequent 6 months weren't positive. Even at low yields, bonds generally have held their value or appreciated during significant stock market declines. And you can see that if you go back to those charts, the chart I had a couple of slides ago, where we looked at the treasury bonds and so that they didn't move as much. And so you see here on a rolling 3-year basis, the correlation between US stocks and US treasuries has varied from -0.6 to +0.6. So that means when that -0.6 means that during that time, they're moving in opposite directions. When it's plus, they're moving in the same direction, but the magnitude isn't quite the same. A perfect correlation at the top would be 1 for a positive correlation. At the bottom, it would be -1 if they were moving completely opposite directions. What happens if rates change? And that's something else that you have to think of, and that's part of what makes some of these other products move more, these other securities move more, there's a relationship between bond yields and a concept called duration. Duration basically measures how long it takes for an investor to be repaid the bond's price by the total cash flows. But it also, more importantly, instead of that technical definition, think about it, it gives us a measure of the sensitivity of the bond or a fixed income portfolio's price to changes in interest rates. The higher a bond or portfolio's duration, the more sensitive it is to changing interest rates. So for example, if you had a shorter, an intermediate term bond fund, and it was paying a yield of 1.2% and it had a duration of 6 years, if rates went up 1%, then that portfolio, the value, because the value of the bond moves opposite to the direction of interest rates, would move by 6%. If the yield went up 1%, the value of the bond would go down 6%. And then if the yield went down 1%, then the interest rate, the yield would go up by 1%. On the other hand, if you have a longer term bond, and that's why you have to, they're much more sensitive to changes in interest rates. It could have a duration of 19 years. And in that case, a 1% change in interest rates could make that yield, could make that price move by 19% up or down. So what can we do? Well, we can think about, if we haven't retired yet, we can think about working longer. But the only concern about that, we think we can work longer, but it's not always possible. According to the Center for Retirement Research, 37% of workers retire earlier than they intended to, not later. We can start reaching for yield and go for some of those bonds that I talked about before, but you have to be careful because now you're adding more risk. You can use an online bank. Online banks generally pay higher yields and higher rates than brick and mortar banks. So going to an online bank as opposed to the bank down the street, you're usually going to get a better interest rates, but they're still not that high, right? The top online yield I could find when I looked last night was 0.76%. If you got a 1-year CD, you're at 1.05%. The maximum I could find on a CD was 1.65%, but that's if you're tying your money up for 5 years. So I don't know how many of us want to tie up our money for 5 years at that kind of rate. And a money market account, the best rate that I could find for that was 0.7%, but that was with a $50,000 minimum balance. Another thing we can do is we can think about using low rates to our benefit, right? We can refinance our mortgage if we have one. I know I have a lot of clients that have refinanced over the last few months and it saved them a lot of money. You can also, if you have a mortgage, you can think about accelerating your debt payment because even though rates are low, if I had a 3% rate or a 4% rate on the mortgage, by paying that, I'm basically getting a 3 or 4% guaranteed return versus the return that I get if I put the money in the bank or if I put the money into another security where it's less than that. You consider a barbell approach and own securities at different maturities, but you can also look elsewhere in your portfolio for income. And as I said earlier, annuities are a possibility, but you want to be careful with them because they can be very expensive. And also if you get into them, it's not so easy to get out. A lot of them have long surrender periods, which is basically, if you get rid of them before the surrender period's over, you're going to pay a penalty. So, sorry about that. So can you just hold cash or low yield bonds? I know I talk to people that want to do that, but the problem with that is we have inflation. And if we look at where the yields are today, inflation is a concern because you're actually, your purchasing power weakens. Right? If you have cash that's giving you 0.7% and inflation is 2%, that means that the purchasing power of your money is less, right? Because prices are rising at a rate in excess of what you're earning on your money. So if you did that over time, the value of your the value of what you could buy with your portfolio would go down. So again, looking at the alternatives, you can delay. Another thing you can think about is if you haven't started collecting Social Security, you can delay it. You can delay it. The maximum you can delay Social Security to is set age 70. And from your full retirement age until age 70, your benefit grows by 8% per year. As I mentioned before, you can work longer, you can change banks, you can take on more risk, but it has to be something you're comfortable with. By taking on more risk, you can increase your equity allocations, you can own higher yielding bonds, you can own preferred securities, or looking elsewhere in your portfolio for yield is another alternative. And that's generally the one that I favor. Is think about it this way. There are, and we'll talk about them more in a second, but there are ETFs, mutual funds, or stocks, if you prefer to invest in individual stocks, that pay a higher return. So you can, instead of changing your allocation from 60% stocks and 40% bonds to 70 or 80%, or changing those allocations, you can just say, within my stock portfolio, I'm still going to keep that 60-40 allocation, but I'm going to look for things that provide me bigger yield or higher yield. And for example, there are dividend yielding, dividend focused ETFs. Yeah, if you get those, you're trading some prospect of growth for income, but the increase in income can truly help. A high dividend yield ETF pays about 3.6%. A dividend growth ETF can pay about 2.5%. So the difference in the first one is that it's primarily focused on holding high yielding stocks. You can also, a dividend growth one is companies that have a record of continually increasing their dividends. You can also find non-US based ETFs. There are some that pay very high. I've seen some that pay as high as 7%, but I don't find them to be good investments, but I can find some at 3%, that kind of yield, that is a reasonable yield. And you think about it, we go back a couple of years, if you're getting 3% from those securities, that's about what you were getting, if not a little bit more than bonds, and it also keeps you ahead of inflation. Those dividend-paying securities also tend to be a little bit less volatile than traditional equity investments because they have that income component associated with them. So that gives you the ability to have a little bit higher yield and have a lower volatility profile overall than the broader market. There are also some securities that you can use that are meant to protect you from downside risk, but those are a little bit beyond the scope of what I'm discussing here because they may not be providing you the same income. And so we're really looking for ways to replace our income. That's it for the formal presentation. I'm going to unmute everybody. And if you have any questions, please feel free to ask. Thanks. Let's see how to do that. Actually, I don't see that I can unmute everybody all at once. So if you want to just send me a message in the chat, or I can't, actually, I'm going to ask everybody to unmute. I'll do it that way.
Phil?
Yes.
Can you hear me?
Yes, I can.
What stocks do you recommend that have very high dividends? I mean, there's one called CIM, C-I-M, that has a really high interest rate. I really don't own it, but I was wondering if you knew anything about it.
I do not know that one. I have to be careful about making individual stock recommendations. So sectors that you can, areas of the market that you can look to for higher yields are telecommunications companies, or some companies in that sector, individual stocks that have high yields. You can look to the financial sector, banks that have some high, there's some banks that pay relative yields. And you can also look to some of the consumer companies and the industrial companies. Those are kind of the sectors of the market that you can provide, that you can find companies that provide a relatively reasonable yield, Susan.
Yeah.
Yeah, I hesitate to, in this forum, to give.
Sure, I understand. I usually find that, because I read all the time, that the companies that are not doing that well, their prices have been depressed and they have a high dividend, I guess, to make it more attractive to invest, I guess.
Yeah,
to raise money, yeah.
I mean, so that's part of it, right? So when a company's out of favor and the stock price falls, the yield's going to go up, but you have to be careful, because if those yields get too high, like that's why I didn't really mention the energy sector, because with oil prices where they are and the amount of capital that's involved in that sector, that's not a sector I'd be looking to for yield, because I'd be worried that dividends would be cut. So I want to look at companies that are relatively healthy. And I like to think of it this way, because there are some stocks that I use for this, that if I'm comfortable with the company and its prospects, I'm not really worried about how much the price is fluctuating. I'm worried about whether or not it provides that yield. If I don't feel that I'm going to need to sell it to raise cash, the thing that matters the most is the yield. So if the level of work that I do to look at the stock tells me that that yield should be relatively safe for a period of time, then I'm okay with owning that stock. And that's kind of what I look for. So that's why I mentioned those specific sectors, because I think those are areas in the market where you can find companies that are more stable.
Okay, thank you.
You're welcome. Anybody else have any questions?
Are there any short-term bond ETFs that you, I guess maybe, I don't know if you can recommend them, but there's one like ICSH and another GSY that they're ultra short bonds, and maybe their yield is not that much higher than an online savings account. I'm not sure. But is there anything, people talk about Mint, and there are other ones that are in that same space. Do you have any thoughts, Phil?
I mean, I do use some of those type of funds, Rich. Typically those are going to be either corporate. There's like a bond fund that I use that's short term, and there's a treasury bond fund that I'll use that's short term. I think those are okay. Look, but the yields on those are, I know the short term treasury yield is like 0.7, right? And the bond is going to be a little bit higher, but the corporate bond is going to be a little bit higher. So the yields aren't going to be tremendous, but you have a little bit less risk, I think, with those because the short term till maturity means that you shouldn't have as much price fluctuation. If you look at the long term charts on those, the prices don't move as much.
You don't have this?
Went off.
Does that help, Rich?
Yes, thank you.
You're welcome.
Hey, Phil.
Yes, Chris.
Chris Belfa here. I hope if it's not too far off topic, I did have a CARES Act related question.
Sure.
I don't know how much research you've been doing on CARES Act, but I know it's a pretty hot topic for some advisors. So I had actually two questions. One was, I know you have to have a qualifying, you have to qualify if you want to take an early distribution from an IRA or something. I know there's a qualification, you have to meet some kind of requirement, but I was curious, is there actually a qualification in terms of justifying how much you withdraw, or is it just you have to qualify as having been impacted? I don't know if you've researched that at all.
So I know what you're referring to. I don't recall reading anything that said the amount, that there was the amount. It was just that you could, if you were impacted, that you were allowed to take a distribution, and then you had 3 years to pay the tax on it. But I don't recall anything that limited the amount.
Okay. And then the other question I've been thinking about with regards to the CARES Act, same thing, is I know there's a provision where you can essentially re-contribute those monies at some point, within 3 years or something. It's like, so if I took out $15,000 because I'm a independent consultant whose self-employed income has not been great in last year, right? So I took out $15,000 and I'm going to spread the tax. I spread over 3 years for tax purposes. My tax guy's going to love that. But then if things go really well next year, maybe I want to just put it back in. I wasn't sure. It wasn't clear to me, like, do you have to put it all back in at once? Can you put part of it back in? I don't know if you've seen much about, what the limits are and how you put it back in. But I was just curious if you had sort of researched how that works, because I didn't know if, like, well, this year I want to put 5,000 back because it had a pretty good year, but maybe next year or 2021 versus then 2022 have an even better year. It's like, oh well, maybe I should put it all back. I didn't know if there was a lot of flexibility, or it's like, oh, one time, that's all you get. I just wasn't clear from the little bit of reading I'd tried to find out.
So again, I have not looked at it specifically, but my recollection from when I did read is that there's flexibility there, and it's really up to you to decide. It's not like you have to say, well, I'm going to put back X amount this year and X amount next year. I don't think you're limited to putting it back once. I just
Okay.
3 years to put it back. That was my recollection when I went through the rules. It's been a while since I did, because I focused on them a lot when they first came out in March or April, and I actually wrote a blog about it. There's obviously things that come out on an ongoing basis, but my recollection is you just had 3 years to repay it. There was no specific rules beyond that. So like if you wanted to wait till 2022 and say, I'm going to repay the whole thing now, I think you can. But if you say, I'm only going to pay half, you can do that. Or you say, I'm going to put in some now and some later. I don't think there's any limitations, because I think, you have 3 years to pay the tax. So as long as you pay it back within the 3 years, my understanding was that you'd be okay.
Great. Thank you.
Russell, do you know anything different than that?
No, I don't know anything different. I mean, there's a max of 100,000, which I just noted in the chat. But as far as the timing is concerned, I'd have to look into it.
Okay, thanks.
That's for an early retirement as well.
Right. So, Karen, I see your question that you put in the chat. So that's not, I need more information to be able to answer that question, because when you refinance, it's not just what the rate is, it's also where in your mortgage you sit, right? Because how many years left do you have? That can make a big difference. If you have, like if you had a 30-year mortgage and you're 20 years in, it might not make sense at all, because the way a mortgage amortizes, the further you get into the mortgage, the more your payment is principal and the less that it's interest. So if you wanted to talk about it, I actually have so you're 4 years in, I see, and then you have 26 years left.
Oof.
I mean, so certainly where the rates are now, the circumstances that I've seen people that were 4 years in on a 30-year mortgage, you're still paying so much in interest each payment that I would think it would make sense based upon where I know mortgages are right now. So I would definitely look into that. And if you want to send me an email, I'd be happy to give the names of some people that I've found that have helped some of my clients with refinancing. Does anybody else have any questions?
I have a question that's completely off this topic.
Sure.
I just ran across this thing the other day. I saw an interview with Mary Beth Franklin, and she was talking about there's a cutoff date for January 1st, 1954. If you were born before that, there's some kind of thing you can take spousal benefits on Social Security. And if you're born after that, you can't. And it was, anyway, what was unclear to me, my situation is that my wife was born before January 1st, 1954. And I was born in July of 1954. We were both full retirement age. She's been drawing her Social Security, and I'm delaying till 70. Anyway, I was wondering, I don't think it's possible for me to take spousal off of hers because I was born after that deadline. Do you have a different, what do you think?
That's right. I mean, actually, I talked to somebody this morning that was the situation. His wife, he was born in 1953, and his wife was born in 54. And the discussion that we had said that when his wife hits full retirement age, and she's not quite there yet, that he could take half of her benefit, because he wants to wait till 70 because he can get the bigger benefit. And so he can take, it's a suspended benefit, and he can take the suspended benefit from the time that she hits full retirement age until he's 70 and then switch to his benefits. So yes, 1953 was the cutoff. That was a change from a few years ago. It used to be that was a really good Social Security planning technique, is for one spouse to take the spousal benefit and then switch to their benefit, but they cut it off. And so that you have to be born before, as you said, January 1st of 1954 to take advantage of that.
I just posted the explanation from the Social Security website.
Okay.
Just look in the chat, you'll see the rule.
Oh.
All right, does anybody else have any questions for me today? All right, then I want to thank you all for joining me, and I will be back again in a couple weeks. Have a great day, everybody. Thanks.
Thank you, Phil.
You want to say, you should have said
Phil,
Phil?
how you doing?
All right.
I understand you said that Diana was coming into New Jersey.
Hold on a second. Let me stop the recording, all right?
Oh, okay.